Hello friends, in this video, I will explain what you as an investor should look at before buying blue chip stocks for your portfolio. Now we have created a list of 7 best blue chip stocks to buy, which are Reliance Industries, Tata Consultancy Services, Hindustan Unilever, Housing Development Finance Corporation, Asian Paints, Kotak Mahindra Bank and Avenue Supermarts. Now this list of stocks is for a longer term horizon, keeping several fundamental factors in mind. As an investor, this video will guide you to make your own checklist and research these stocks better. Firstly, a brief on blue chip stocks. The term blue chip originates from the round of poker where the blue colored chips are relatively more valuable. Similar to the game, these are a set of stocks which are more valuable in the market and hence are termed blue chip stocks. So now here are a few signature characteristics which you can look for while researching these blue chip companies. First, they are large reputed companies. They have widely used products and services. Most of these companies are listed in the market for a very long time. Now these blue chip companies have survived a number of bear phases, market crises, financial troubles, etc. and they are still going strong. Now blue chip companies have a strong balance sheet, that is a large number of assets as compared to liabilities, and a healthy income statement, that is revenue and profits continuously growing for the last few decades. Now these companies have a good past track record of stable growth. But not all blue chip companies will give you the desired returns. Hence, you must pick companies which have a track record of consistently increasing the top line and operating margins. They should generally be debt-free companies or operate with a low amount of debt levels. Now blue chip companies are known for rewarding their loyal shareholders with consistent and increasing dividends. Also, these companies have high return ratios, that is both return on equity and return on capital employed, high interest coverage ratios and have the ability to consistently generate cash flows. Now let's look at a few factors in details. Firstly, the top line and bottom line. The top line refers to company's revenue while the bottom line is the company's net income. It is important to pay attention to them for signs of any changes from quarter to quarter and year on year. Any significant decline should be a red flag which would need a deeper look. Consistent growth is what an investor should look for. For instance, Housing Development Finance Corporation, that is HDFC Limited, which is India's premier housing finance entity, has a top line CAGR of 16.06% and bottom line CAGR of 19.59% in the past 5 years, which is considered decent enough by a blue chip standard. Now next is operating profit margin, which is also known as operating income margin, which is a measure of how much profit a company makes after deducting its variable costs of production. A company needs a healthy margin in order to pay its fixed obligation such as interest on debts and taxes. A high and improving profit margin is an excellent indicator that a company is being managed well. Now Hindustan Unilever, which is among India's largest FMCG company with diverse product portfolio, has consistently improved and delivered consistent operating margin around over the past 5 years and currently stands at 25%. Now moving on to return ratios such as ROE and ROCE. Now both these ratios are used to measure efficiency with which a company can generate profits. Now these ratios are of utmost importance which should be compared with industry peers to pick the best bets. The trends of these ratios should be looked at to see if they are improving or not. Now you can see that companies in our model portfolio have clocked healthy return ratios. The next matrix to look at is debt to equity ratio, which helps to determine as to how company finances its assets. Now too much debt can pose a risk to a company since the cash flows will be used to meet the debt obligation instead of reinvesting in the company itself. It is seen that all the stocks in our model portfolio have no or lower debt levels. Now these companies will enjoy a higher valuation compared to highly indebted ones since they'll be able to conserve cash and reinvest instead of paying interest. Now these cash reserves will help them to fight against uncertain and unprecedented times like the current situation. Now this is the sole reason why blue chip companies have survived a number of bear phases, market crises and financial troubles, etc. and are still going strong. Now coming on to EV upon EBITDA ratio. Now this is a popular valuation matrix used to compare the value of company to its industry peers. it is idle for investors looking to compare companies within the same industry. The comparison of relative value among companies within the same industry is the best way for investors to determine companies with the healthiest EV upon EBITDA within a specific sector. Now, this ratio can also help in understanding if a stock is overpriced, fairly priced, or underpriced relative to the company's true money-making potential amongst the same industry. Let's take a look at our model portfolio. Now you can see that Avenue Supermarts, which operates supermarket chains under the brand name D-Mart, seems overpriced when compared to others, whereas Reliance Industry has the lowest EV to EBITDA ratio. Now next is dividend yield. As explained, blue chip companies are known for rewarding their loyal shareholders with consistent and increasing dividends. Now dividends are portion of company's profit that are distributed to shareholders. Now it is important for an investor to find out that a blue chip company is consistent and is increasing dividend over a period of time. Taking a look at our model portfolio, each company pays a good amount of dividend yield except Avenue Supermart, as it is still in growing stage. Now amongst blue chip banks, Kotak Mahindra Bank stands out on all parameters, which is also included in our model portfolio. The bank is superior on all fronts, namely profitability, net interest margins, controlled formation of bad loans, that is the non-performing asset, a share in low-cost deposits, that is the CASA deposit, provision coverage ratios, and last but not the least, decent valuation when compared to other blue chip banks. Now if you want to know more about how to analyze the banks, please check out our Best Banking Stocks to Buy video for detailed explanation. Now, hampered economic scenario, uncertainty, and in turn prevalent risk aversion among market participants have all brought back the interest of many market participants to blue chip stocks. Now, given that these quality companies are more resilient to economic downturn, they may continue to grow and operate profitably even during adverse market conditions, and hence investing in blue chip stocks is recommended for investors with a conservative risk profile to meet their long-term goals of at least 5 to 7 years. Investing in these companies is ideal for all investors to grow their wealth over a long period without exposing themselves to a lot of risk and volatility. Therefore, an investor's portion should always be allocated to blue chips in order to cushion their portfolio during difficult times. Thank you.